So this is for the old exam that's labeled Exam 1 SP 18-2. So again, I'll go straight to the problems. Number 21. So this one only had 20 multiple choice questions. On September 1st, Triton Entertainment signed a 500,000 discount note to be funded to fund expanded operations. The note was issued to Nevada Bank, and the terms were 9 months, 12% annual rate, simple interest. The note was paid in full at maturity. Triton's fiscal period is the calendar year. So prepare the journal entry for the issuance of the note by Triton. So this time we're not having to do the bank side of this, just the borrower side of this. So we're going to have September 1, which will be 9/1. And we've got 500,000. And it's 12% annual rate. But that's only for 9 months, so that's 3/4 of that. Let's see, 4 divide 3 times. You get the same thing if you were to divide by 12 and multiply by 9. So 45,000. So that's going to be our discount, right? So we are going to, as Triton, we are going to receive cash $455,000, 500,000 minus the 45,000. We'll have a discount on note payable, 45,000, and cash, or I'm sorry, note payable. Thinking the bank side for a second there. Note payable of 500,000. Okay, and then we need the adjusting entry on December 31. So 12/31. So we've got September, October, November, December. So 5 nights, right? So 45,000 divide by 9 and then multiply by 5 would be $25,000. And this would be interest expense for $25,000 and discount on note payable. And then on the maturity, so this is 9 months, so September, October, November, December, January, February, March, April, May. All right. So it would be payable on June 1st. So that would be 6/1. It could be May 31st or 6/1, June 1st. Either way, we would have note payable, $500,000, and we would have cash, $500,000. Okay, but we still have 20,000 of this discount on note payable, so we also have to do interest expense, 20,000, and discount on note payable, 20,000. Now, if you wanted to make that into one entry, note payable, interest expense, cash, and discount on note payable, that would be perfectly acceptable. I keep them separate, but if you want to put them together, you got there, right? You got to the proper place. Okay, number 22. The following selected transactions relate to liabilities of Chicago Glass Corporation. Their fiscal year is December 31. Okay, so on January 15th, they received $7,000 from Henry Construction towards the purchase of a $66,000 plate glass to be delivered on February 6th. So on 1/15, we're going to receive cash of $7,000, and we have unearned revenue. And remember, it says revenue, but this is a liability account, right? It's one of those ones I talk about masquerading. It says it's one thing, but it's really something else. On February 3rd, Chicago received 6,700 deposits relating containers used to transport glass components. So that would be on 2/3. They get cash of 6,700, and they would have a refundable deposit liability for 6,700. So that's number 2. Then number 3, on February 6th, Chicago delivered the plate glass to Henry Construction and received the balance of the purchase price. So it was 66,000. They paid 7, so we would receive 29,000. That would be 2-6. So cash of 59,000. Now we're going to change our unearned revenue of 7,000 into sales revenue. Okay, now notice that we would have some kind of cost of goods sold, either it went into inventory, back out, but there would be some kind of cost of goods sold, but we don't have any information on that here, so we'll just ignore that for the moment. We're focusing on the revenues and the liabilities in this chapter. And then number 4, first quarter credit sales totaled $700,000. The state sales tax rate is 4%, and the local sales tax rate is 2%. Okay, so 700,000, 0.02. I'm doing 0.02 because we can just double it to get the 4%. Is 14,000, so the sales tax will be 28,000. So we would have first quarter, January, February, so March 31st. We would have accounts receivable, 742,000. We would have sales revenue of 700,000. We would have state sales tax payable for 28,000, and we would have local sales tax payable for 14,000. And that would be that one. All right. Number 23. Hey, Big Dots provides a 1-year warranty with all its products it sells. It estimates that it will sell 350,000 units of product this year, and the total revenue for the product will be 105 million. It also estimates that 75% of the product will have no defects, 5% will have major defects, and 20% will have minor defects. The cost of a minor defect is expected to be $6 for each product, and the cost of a major defect is about $21. The company also estimates that the minimum amount of warranty expense will be $1,500,000. And the maximum will be $6 million. Prepare the journal entry for 2016 under warranty. Okay, so we got to do a little bit of math. Yeah, I'll go ahead and do that, and then we'll talk about B, C, and D because they're not part of this problem. I don't know what happened there. I don't remember what happened there. I probably knew at the time. Okay, so we have 350,000 units, and 5% times 0.05 is 17,100 major defects, and a major defect is $21. Is 367,500. We also have 350,000 times 20% is 70,000. I don't know about a product that has 25% defects. All right, and that the minor defects are worth $6 a piece is $420,000. Add those two together, and we get 787,500. Now, they also estimate the minimum amount of warranty expense will be $1,500,000. So since this is less than that, we're going to use the $1,500,000 here, and we will have warranty expense for $1,500,000 and warranty liability for $1,500,000. Okay, I'm starting to remember what I replaced a problem, and this was a redemption of some coupons. And obviously, we don't have the information to do C, D, and E. The problem that got replaced here was cans of soup could be turned in. I think 5 labels of a can of soup could be turned in for some kind of premium, and So some kind of, or a discount or something, and so that. But we obviously don't have those, so I'll try to take those off before I send them to you. Okay, number 24. On January 2nd, Lincoln Motors issued 1,000 $1,000 par value bonds to finance a new showroom. Remember, I mentioned that the standard denomination of bonds in this country is $1,000. Now, there can be $10,000 bonds, $100,000 bonds, but the standard issue is $1,000 bonds. The bonds are 5-year, 6% bonds that pay interest on June 30th, December 31. And so we're not going to have any adjusting entries on this. So number one is compute the selling price of the bonds. So the first thing we have to do is what's the total face value, 1,000 times 1,000, and that's going to be 1 million. Check that just to be sure. I'm pretty sure. Yep, it is. Okay. So that's the face value. That's not the selling price. And so the market rate, the investors required 7% interest, and the bonds are due in year 5. So these are 5-year bonds. So we're going to use table 2 again. And so cut the interest rate in half. They pay twice a year, right? So 3.5 times at the 10. So this is 0.70892. And it's 6% bonds. So that means they're going to pay $30,000, right? Half of that, 3% of a million is 30,000. And so now we go to table 4. Oops, that's table 6. Now we go to table 4. And the same thing, 3.5, 10 years, 8.31661. And multiply those out and add them up. Is 249,498.30. I'm going to round it up 498. And this 1 million times 0.70892 is going to be 708,920. Add those two together. We get 958,418. Do the common sense test. Interest rates went up. The value went down, right? We had $1 million value, face value, but the market value is 958,000. All right. So that's the selling price of the bonds. That's part 1. Then part 2, prepare the journal entry to record the sale of the bonds. We're going to have cash, 958,418. Discount on bonds payable is going to be 41582. And then the bonds payable will be 1 million. Okay, number 3, prepare the journal entry for the first and second interest payments. Now, you'll notice here I did not specify simple the straight line or the effective interest rate method. If it doesn't say, always assume the effective interest rate method. Okay, so for 3, we need the carrying value, 958, 418 times the effective interest rate of 0.035 gives us 33,545, 44.63. I'm going to round that up. And so the first interest is 6 30. Year 1 is going to be interest expense for 33,545. We know we're going to pay cash. We calculated that up here, 30,000. And so this will be the discount on bonds payable or amortization of discount of 3,545. Okay. So that's the first journal entry. Then we need to do the second entry. So we take the original carrying value, 958, 418, add the amortization of the discount, 3,545. We get 961, 963. We multiply that times 0.035, and that's going to be 33,669, 8.7669. Okay, so on 12/31, year 1, we would have interest expense of 33,669, and of course the cash will be the 30,000. So that means our discount on bonds payable is 3,669. All right, so then number 4, ask us what's the carrying value. So we take the carrying value here, 961, 963, and we add the amortization of the discount, 3,669. is 965, 632. So that would be part 4. What is the carrying value? Okay. All right, on this one, they ask us to determine the price of each bond. Each case is independent, so we're going to be using our tables. A bond issued $10 million with a 6% coupon, interest paid semi-annually. The bond is for 20 years. The market rate of interest is 8%. So we're going to have the 10 million. And then, so that would be 3% of 10 million would be 300,000. Right. And so get out our tables. And table 2. The market rate is 8%. So we're going to use 4 for 40. Is 0.20829. And again, I'm just going to flip over, get the factor, and then do them together. 4% for 40 periods, 19.79277. $300,000, 19.79277. Multiply that out, we get 5,937,831. 10 million times 0.20829 is 2,082,900. Add those together. We get 8,020,731. And again, we asked, does that make sense? Yes. The interest rate went up, so the value went down. Okay. So part B. Now we've got the $10 million with a 12% coupon. So still paid semi-annually, so that's going to be $600,000. And the bond is for 10 years. And the market rate is 11%. So we're going to go to the 5.5. We need table 2 first. And we get the 5.5, and that was for 10 years, so 20 periods. 5.5, 20 periods, 0.34273. And 600,000, jump over to table 4. $5.5 for 20 periods. 11.95038. Let me check that. Table 2. 5.5, 20 periods, 0.34. Yeah, okay. Just felt like I moved further down the table on that second one. Check to make sure I picked up the right number. Okay, 10 million. Enter 0.34273 times $3,427,300, 600,000. Enter 11.95038 times 7,170,228. Add those together. We get 10,597,528. Yeah, so interest rates went down just a little. So the value went up. That makes sense. All right. Zero coupon bond. That means they have no interest payments going on. It's just 15 years and the market rate is 7%. So we just take the 10 million and all we need this time is table 2. 15 years at 7%. We can use the 3.5 at 30.35628. And that puts it comparable to semi-annual interest payments, which again is the standard in this country. 10 million. And we get 3,556,280. And how come this one is so much lower? It's because you're not getting any interest payments over that 15 years. You're just getting the lump sum of $10 million back when it's all said and done. So there is no intervening interest payments on that. All right. 26. Yeah, this will be the last one for this exam. And we have Falco issued a $20 million bond with a 6% coupon paid semi-annually 3 years ago. The bond was originally for 20 years in order to clean up their balance sheet to prepare for a public offering of stock. Falco decides to buy back their outstanding bonds of this issue in the marketplace. The current carrying value of the bonds is $22,750,000, and they repurchased the bonds for $24,100,000. So what you know already is they're redeeming the bonds payable, right? And that's 20 million. And they're paying cash of the 24,100,000. Okay, that you know already. You don't have to do any calculations, right? Okay, so you've got to get rid of the carrying value is 22 million, so that means that they have a premium on bonds payable, right? So to get rid of the premium, you have to debit it, because when you do the initial, you get cash greater than the face value, but the bonds payable are the face value, so we have a credit for the premium. And so to get rid of that premium, we have to debit it. And so we're going to get rid of the premium on bonds payable, and that's going to be 2,750,000. All right, so they obviously paid more than that. So they paid 24,100,000, and they got off their books 22,750,000. In order to do that, they took a loss on redemption of bonds payable for 1,350,000. The trick, to me, the trick is just go from what you know for sure. Then the one calculation, which is just the premium, you got to get rid of that, and whatever is left is going to be either a gain or a loss. A gain will be on the credit side, a loss will be on the debit side. So, yeah, that should be pretty straightforward on that. All right, so that is exam number 2. I'm sorry, exam 1, but the second one that we did. All right, let's stop this and continue.